You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, welcome back to Options Playbook Radio, the program here on the old network where we break down the sometimes scary, sometimes impenetrable world of options into some offensive and defensive plays that you can use in your own portfolio. Looking for a little bit of income, maybe looking for a little bit of defense, some protective puts, maybe some speculation, maybe all of the above. Don't worry, we've got you covered. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the aforementioned Options Insider Radio Network. And you're saying to yourself, I've heard this guy before, but he's not usually on this show. What's going on? Are they mixing things up? Well, allow me to introduce your regular host, the options guy, Mr. Brian Overby, the senior options analyst over there at Ally Invest. Brian, welcome back to your own program, sir.
Oh, it's always great to be back, and I always love when you're doing the introduction because that means that we're going to get to some of these listener questions, and they just seem to pile up week in and week out. So it's always awesome when we can huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via questions@theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or via the Trader Network at tradeking.com.
All right, everybody, welcome to the huddle, the portion of the show where you guys take the reins with your questions, comments, and insights. Let's see how many we can get to. Brian, we got a bunch, as you alluded to. This first one here, I think, coming through the Options Playbook website. So, and it's from Janice, and she's just writing to you, Brian. So apparently, I'm chopped liver. She wants to know so she says, "Hi, Brian. I just want to say I really appreciate your clear, concise manner of speaking and content." So there you go, Brian. You have a fan. She goes on to say, "That being said, I have a question about the way you talked about the alternatives available for managing the leap option put spread if the market goes down. I may be being overly analytical, but I am learning and find that folks that are experienced like yourself will drop little gems of wisdom without even knowing they are doing it, and I find listening to you guys so helpful. Anyway, in this case, what you said, re managing the trade, didn't quite make sense, and perhaps it was just a punctuation that was needed. You said we can remain long the put, long put and short the short put, and close out or sell the 430 put and just remain long the stop." And in parentheses, she puts option, I presume. I'm pretty sure there's something wrong with this sentence. Maybe you meant to remain long the long call, but then the rest of the sentence doesn't make sense. I have been using this strategy for a while and really like it, but really like to make sure I understand the management of the options clearly. Thanks again, Janice. Oh, she's up there in Canada in the frozen north. That's nice to see we have some listeners in the frozen north. Hopefully it isn't too frozen for you guys up there, Janice. Well, Brian, since she's talking to you, I'll let you have your crack at it. What do you have to say to Janice?
Well, first of all, I have to admit the Canadians do. I think it's the hockey stick profit and loss graph that draws them to them. But Canadians seem to love options.
I knew you had a secret sauce for this one. That's what it is.
And I agree with Janice. It was very confusing. And I remember being confused when I was taping it with a big smile on the end. So overall, what I was saying, and this was probably one of the hardest strategies to just talk about without a graphic on Options Playbook Radio, but it's one of the strategies that I really like, and I think a lot of people should look into it, and it's just basically an alternative to buying stock outright. You're going to buy a long call option and then sell a put spread to help pay for the call option. Now, another way to say it, and there's more than one way to address this strategy because of the complexity, is you can go out and buy a call, sell a put, which is synthetically long stock, and then buy another put as protection. Okay, so there's two different ways to look at it. And when you're talking about this strategy, I like to look at it as I'm long a call and short a put spread. It's a very bullish trade, but it has a protection component in it. So when Janice was mentioning this and I said long stock and she was saying long stock option, no, I was actually saying I should have said synthetically long the stock. So what can happen here is if you are long stock, short put, the market goes down and you have a long put, what's really interesting is you can just sell out the put, and then right at that moment, you are synthetically long stock to the upside. So that's one thing that I find is very interesting in this strategy. And then Janice went on to ask about a couple of other different scenarios. And one of them that I was also talking about is when you have options that have delta and gamma and theta and have different things that are involved in the pricing of them. If you are wrong, if you put on this position and you are wrong, and let's say the stock goes down and it gets to your long put strike, all right, in this scenario, sometimes what I would like to do is just close the short put and sell to close the long put, which just leaves you long a call option. Now, here's the dynamic that's very interesting about it is as my long call option gets out of the money, which would be happening in this scenario that we talked about on that podcast, as that happens, now my delta of my long call options gets smaller and smaller, and it hurts me less and less over time. Now realize we're talking about longer term options in this scenario, but that's just such an interesting component of this trade that you can put on. And as opposed, and we were talking about expensive stocks, you got the FANG stocks out there, you have Tesla, you have a lot of, now we're getting to a lot more of $100+ stocks out there that people are interested in trading. And just doing it this way, if you are approved for this type of option trading, and once again, nothing's ever meant to be a recommendation as far as you'd have to look at your portfolio to do these type of strategies and make sure that you're okay to do them. But one other scenario in that comes down, you're long that call option and you can just remain long the call option and it won't hurt you as bad because now you have limited and known risk by that long call. Okay, now let's talk about the good scenario. The good scenario is I have this position on and the market starts going up. The same thing can happen. I can sell out the put spread, gain a profit on it. In theory, if the market's going up, the put spread should make money. The short put spread should go down in value and make you money. And then the delta of your long call option, if it's getting in the money, should now start working a lot like the stock. So you close out the short put spread, you make a profit on it. And I always like to say, well, I want to look at closing out the short put spread when the delta of the long call is getting to 70 or 80, where it's getting to a position where you basically are having a surrogate for the stock via your long call option. Now, I don't know if that explanation right there was helps with the confusion, and I really hope that Janice listens because I really enjoyed the question and all the kind words that she said. But there are 3 different scenarios, and I'll just set it up and I'll say it short in summary, and we'll just call it a day on this question. One scenario is the market goes down, you just sell the put, and you remain synthetically long the stock. Now you have to have the requirements to be able to buy stock at that strike price that you did this trade at. Secondly, the market goes down, you lose on the short put credit spread, and you just remain long the call, and you hope that if it continues on down, you just don't get hurt as bad. Lastly, if you're correct, the market goes up, you once again close the short put spread, but this time at a profit, and just remain long the call option. You just have so many more ways to approach this trade than just buying stock outright. And that's why I find this trade interesting. I never did put it inside the options playbook. If you go in the options playbook, you can only see synthetically long and synthetically short stock. It's called a combination. But when you throw in that protective put, it really makes this an interesting scenario, especially going into like what we saw this week. You got kind of an overblown scenario in a little bit of a bubble effect, specifically in a lot of the FANG stocks, and people all of a sudden are worried about interest rates, and then boom, you get a big down day in the markets like we've had. Or I wouldn't even necessarily call them down days. I'd just call them volatile days. So.
All right, good question, good answer. I think we got time for, let's see if we can squeeze in a couple more quick ones. Here's an interesting quick one. It kind of relates to what we were talking about last week, Brian. When I saw this one, it made me think last week you were talking about boxes, which kind of surprised me. And it seems like an appropriate question from Matt. Matt Williamson wants to know, what's up with the Facebook $5 calls? Yes, he says yes, in parentheses, $5 in Jan 2019. The open interest is climbing past 12,000. So I thought that was interesting. So I went and took a look. After Matt sent this in, and he is indeed correct. The Facebook right now is trading about $180. These Jan 2019 $5, yes, 5 strike calls have nearly 12,000 contracts open. And so you see that your first blush is probably, maybe that's legacy paper from when the stock was much cheaper, and it's kind of just, nope, I dug in the OI. A lot of it was opened in the last couple of weeks. In fact, 2,000 more traded today, or just about. So we're probably, if this is opening, this could be another 14,000 or close to it on this strike. That puts it in like the top 30 or so in terms of big open interest positions in Facebook of these Jan 5 calls. So my second thought was what you were talking about last week, Brian, which was a box or something like that. Usually if you're doing an interest rate play, you use deep in the money strikes for some of it, and yet I don't see any of the corresponding legs on this for anything else. So it doesn't seem like it's a box either, Brian. So it's a bit of a mystery. Matt brings up an interesting question. And I'm curious, Brian, since you've been doing a lot of deep in the money type of spreads and risk analysis of late, what would your thoughts be? Why would you think someone would come in here and trade? Looks like a lot, the 1,895 that went up today, a lot of them are going up in small chunks, 20 to 50. And a lot of them looks like they were lifting offers or close to it. So it seems like they were perhaps opening buys again. So what would your thoughts be on, in general, why someone would trade such a crazy deep in the money option?
Well, you took my thunder away. I did actually have a scenario like this that happened before, where someone asked a similar question, and I think it was in a big European style index, and the answer was that it was a box. But I'm looking at the volume and open interest, and I'm seeing a lot like what you are saying. And the main reason why you would do this is because you do some type of interest rate play and you'd have some decent liquidity. But it is, what's crazy about that option in particular is the spread isn't nuts on it, right? I'm currently showing it bidding 174.60 by 175.95. So it's not even a $2 spread in it, which that's just, I don't I think I'm just as dumbfounded as our listener is here trying to figure that one out. It almost makes me intrigued to try to find that answer. Now, On the other side, if you could see it on the put side, well, then you're just talking about just pure speculation, especially if it's been recent that has happened. And it's going to actually bring up something that was in my memory from a while back is we saw large open interest going into the car companies into 2008 on way out of the money puts. And those ones actually became, worth something, worth a lot of money going into 2008, what happened with all the car companies. So I find that very interesting, but I don't usually see it on the call side. I see people speculate on the put side with large open interest on companies that they just don't think are doing things correctly. But I guess I'll punt that one back to you.
Yeah, because you're effectively at this point you're synthetically trading the stock almost. It's a $175 in the money option. So you're right. I think you're getting clobbered on the option spread versus just trading the stock outright. So you have to have some incentive for a reason why you're doing the option. I heard some people speculate maybe if they were selling. Doesn't seem like this latest paper is selling, but the executions on these wide spreads could be kind of funky. So it could be still selling paper. In which case maybe they're trying to do an end around some sort of prohibition against selling the stock in some sort of employee agreement. Maybe I've heard some speculation about that, which could perhaps make sense. All these agreements are different. Usually they would prohibit something like that, but perhaps there's a loophole they found for deep in the money calls, and they're using that. That could potentially be it. But you're right. Funny you mentioned out of the money put paper in car companies, Brian. I'm gonna give you a little pop quiz right now. I guarantee you'll get it wrong. Don't worry, because if you got it right, I'd be kind of concerned. But if you had to guess right now, talking about car companies out of the money puts, hint. What do you think is the number one open interest position right now in Tesla?
Oh, really? Oh, gosh. Open interest. Am I picking a month in a strike?
Yeah, it's a hard one. So feel free. I'll give you a range if you want to go for it. Okay. I'll give you a hint. It's not what you think.
Okay. All right.
Second hint is kind of what you were talking about before.
So I'm going to say 100 strike puts going out to 2020.
Wow, very close. Very close. There.
Really?
The Jan 2019 50 puts. That's the biggest strike, biggest open strike by far in Tesla, which is crazy when you consider how active Tesla is. And also the fact that we've been tracking these for like 6 months. They continue to grow, and they trade a couple of hundred a day. And people, you mentioned 2020. Now the Jan 2020 50 puts are out there, and they're trading actively. It's about 8,000 open there. And there's about close to 40,000 open of the 50 puts in Jan 2019. So someone's playing out there and extremely out of the money puts in car companies again as well. So that's talking about funky out of the money paper. Since we're talking about puts, let's wrap up with this question here. I like this handle. You got to give him some shine just for the handle. Johnny Bananas. Johnny Bananas wants to say, quick question. If you buy a put option and the strike price is $5, I guess he means the stock. He left that out. And the stock drops to $3, is it still worth money even if it's $3 under? Brian, we answered a similar question a month or two ago. I guess people just have confusion about when puts work. So maybe we should walk them through that again really quickly, because Johnny Bananas and some of our other listeners, clearly these are scenarios where they should be very excited, and yet they clearly are not. So maybe you should walk them through really quickly. When you buy a put, what the heck let's say in this scenario, you buy a put on the 5 strike, the stock drops to 3. Should you be happy or sad, Brian?
In general, you should be happy, assuming that you just own the put outright. That's one of the best scenarios that you can get. And I don't know if it's just the low valuation a $5 put that could potentially go to 0. I think that's where the questions come in. They don't really understand who's going to give them the stock, right? If you go and exercise your put and you're trying to sell it at 5 and it's trading at $3 or below, who's going to do that? That's the only thing that I can think of for Johnny Bananas, which I do love the handle too. In general, that's how it works. The market goes down. There will be somebody, there will be a clearing firm, there will be the Options Clearing Corporation that will make sure that if you exercise your put and the stock is trading at 3, that you will be able to sell it at 5. That's the way that they work. It's very straightforward. Even if it goes to 0, that will happen. Now, the only time where you really, and this kind of happened going back to 2008, we're doing a lot of flashbacks because of the volatility stuff. You might have a scenario where the stock doesn't open up. And that's where it really generates a lot of questions. You know, the stock's not open, the stock can't be traded. What happens if I exercise my put? Well, you can still do that at that point in time, but the market's got to be trading in order for you to actually be able to sell or exercise and actually get out of that position. And you don't know where the market's going to open at. So that's the only time that this question should really apply, is on an underlying that has stopped trading and you don't know where it's going to open.
No, Brian, I lied. I know we have to wrap up, but we have one more. The next question is so appropriate to what we were just talking about that we have to do it. We were just talking about Tesla out of the money puts. Guess what the next question is all about? It comes from Adam Linlin. He says, I'm thinking about getting a Model S. It's not a small purchase, about $85,000. So I'm a little concerned about the future of Tesla Motors. Will it be around to service my pricey vehicle in 3 to 5 years? So I thought I should purchase some insurance. The question must come in a little while ago, because he says the longest listed puts are January 2019. They go out to Jan 2020 now, Adam, so you can go a little farther. I don't want to pay through the nose. So I'm thinking about picking up the Jan. Brian, this is exactly what you just said. About picking up the Jan 100 puts for about $4. By my math, if Tesla goes bankrupt, I will be sitting on a cool $96,000, more than the cost of my car. If it doesn't happen, then I'll probably roll about 6 months out, so it'll cost me a little more. But all in all, I don't foresee spending more than $1,000 during the life of the car. Am I crazy for thinking about that? There you go, Brian. He's asking us if he should buy your favorite strike, the Tesla Jan 2019 100 puts. It's kind of interesting. He wants to create his own insurance policy for his car, lest Tesla go bankrupt. Maybe he's the guy buying up all these crazy puts in Tesla. What do you think?
Yeah, maybe it is him. Maybe he went to the 50 instead. But bottom line is, it's funny because I did not read this question beforehand, and I thought
for sure you read this. That's where you got the strike from.
No, I didn't because I didn't think we were going to address all of those questions at this point in time. So that is so funny that he came up with it. I love the idea. I absolutely love this idea. And I will say that I have done something similar in that I've done a little bit on the gas side of things when energy was plummeting, right? When the gas prices and oil prices were just going down lower and lower. I own a few boats and I have a fairly big gas bill, and I always thought that I don't mind going out and buying long energy, because if the market continues on down, I save it on the other end. I save it in gas prices and house prices. And I think that that's fairly similar to this. If Tesla were to go bankrupt, he is correct. Now, the thing is, are you going to hold it the entire time? In other words, are you going to buy these puts and just hold on until January of 2019 and see if the underlying market has gone down that much and gone to zero? Because if you hold it out and you really think that could happen, if you're going to make this type of an investment in a vehicle, I don't think paying $4 for those puts is unfathomable. And I just like that he's done the math, and that if it goes to zero and I can't get my car serviced or anything happens with it, I actually get my money back for my car. And it's a physical way of selling a worthless car.
There you go.
Interesting concept.
Yeah, I like it too. He did the homework for us. He said he would roll. Yeah. He would roll 6 months ahead of time. So he would roll. So he would keep keep the put alive. So he wants to limit his outlay to $1,000. But I appreciate guys who go the extra mile with these types of questions. And it just seems so perfect. I thought for sure you read this question, Brian. That's where you got your strike from. That said, Brian, if people want to keep hitting us up with more questions, maybe they have other suggestions for ways they could hedge your vehicles. They want to hear your thoughts. Where should they go? What should they do?
All right. Well, obviously, you can always just send me an email, and we might show up on a huddle up. My email address is theoptionsguy@invest.ally.com. That's the options with an S guy @invest.ally.com. And always check out our education section over at Ally Invest. We have a lot of free webinars that are very timely that we do throughout the week. So please check out our education center, and we'll see you same time, same place next week.
The Options Playbook was brought to you by Trade King Group. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to TradeKing.com/ODD to review additional risks involved with trading options. Securities offered through TradeKing LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.